You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Welcome, everyone. My guest today in this episode number 2 of What's Up Digital Lending is Clifford Tjiok. He is the COO with LOANCOS from Frankfurt in Germany. My name is Constantin Fabricius, and I am the host of this podcast. LOANCOS is a service provider for property-secured financial products. In addition, LOANCOS enables institutional investors to enter the asset class real estate loans. It's a pleasure to have you here, Clifford. Welcome.
Yeah, many thanks, Constantin. I'm glad to be here on the podcast.
Now, pay attention, please. The content of this podcast is expressly not to be considered investment advice, but is intended solely for your information. We do not assume any liability and will not share any profits. Clifford, I have already spoken a little bit about LOANCOS, but firstly, we want to know more about you and your role with LOANCOS. May I ask you to introduce yourself?
Yeah, sure. I'm the Chief Commercial Officer at LOANCOS Group, covering sales, strategy, and financing. And I joined 7 years ago, 2015. And before that, I've been in banking and finance for 20 years. Primarily with large banks like Deutsche Bank and Citibank. I was there in risk management and then moved to the business side. I was at Helaba, Landesbank Hessen-Thüringen, heading up the syndications function at corporate finance, and then had a stint back into risk management where I was the chief credit officer at Talanx Asset Management, and that was my previous role before joining LOANCOS.
Okay. Great, thank you. What exactly is LOANCOS doing? According to your website, you are a digital lending platform, you are servicing loans, and you are offering investments in residential real estate loans. Could you please elaborate a little bit more on these 3 fields of activity?
Yeah, sure. We're doing 3 things, as you alluded to. We are a credit platform. Basically acting as, credit platform as a service. Okay, that's a big thing. And as part of that, we also do residential mortgage loans, German residential mortgage loans, and have an asset base of 4 billion assets under servicing. That's the first thing. The second thing is we offer backup services for other loan platforms and financing platforms. And that's actually the fastest growing business that we have at this point. And so this is like a function where we step in when the existing operational platform is no longer able to perform its duties due to insolvency, for example. And the third thing that we're doing is we're working for investors and for other creditors, working to enable them to get the money back in case that a loan is no longer getting repaid. So either that, so it's like what we call sub-performing loans, or if it's totally defaulted, which we call non-performing loans. Right. So that's what we do.
Okay, thank you. Let's have a closer look on outsourcing. This thing, the outsourcing of loan processes, is not really a new issue. What is so appealing about LOANCOS? What distinguishes you from others in the market?
Well, due to the fact that our group has been active in outsourcing and processing loans for 23 years now for banks, insurers, and fund structures, we have a wealth of know-how how to deal with outsourcing and also with loans and claims management. I think that's a key thing that we can contribute also in further developing like industry standards that we do actually actively within the VDK and in the BSK, Bundesverband Kreditservicing Ankauf and Verband der Kreditplattformen.
Okay, just for the audience, VDK is the Verband Deutscher Kreditplattformen, the Digital Lending Association in Berlin. Yes, and which areas should be handled in-house, and where does it make sense to outsource processes?
Interestingly, the insurances have led the way here, and if you compare it to like banks do everything themselves in terms of production, credit analysis, reporting, and everything that you need to manage a loan during the entire life cycle. And if you deploy an outsourcer or a servicer, basically everything that is standardized can be outsourced. And that is what the insurance companies are doing, for example. They are only interested in buying a product off the shelf, which could be like a consumer loan or like a mortgage loan. Whereas so basically they're prepared to pay for that. It's all in the price. And banks think that they need to do it all themselves. So that's the main reason. And one of the reasons that banks have like as a counter argument not to outsource is basically, look, it's a core process. There's like audits involved, and they need to do this on a regular basis. There's the big regulatory aspect to be considered. What we're saying in this case is everything can be handled by like a servicer. And obviously, due to outsourcing regulation, you need to retain a specific set of skills and of functions within the bank to be in a position to manage the outsourcing, which is fine. And we always deal with that. So what we do is we provide everything that the bank would need to be in a position to outsource. So you need like reports on an ongoing basis. There needs to be like regular reviews with the bank, and that is all working well. And the beauty of it is we take care of everything associated with the outsourcing, i.e., all regulatory compliance. We need to ensure that. We take all audits. And audits, there's quite a lot of audits, right? There's like the internal audit. There's the external auditor that does their regular reviews on an annual basis. And there's the regulator himself, which like pop in every now and then. So that's quite a fair bit. And then you have additional audits from the anti-money laundering side and a number of other regulated bank processes. So that's like something that people usually in from a bank side wouldn't see, because they only benchmark with direct cost, which is like people cost for staff. But that's not all. Mm-hmm. And the other is like a huge, like massive Überbau, which people typically don't take into the equation.
Let's stick to the regulatory aspects. Mm-hmm. In summer, our trade body adopted a branch standard on outsourcing. And what is your view on such industry-driven initiatives, in contrast especially to regulatory requirements?
I think these initiatives are highly important because they're shaping like industry standards, and we've also contributed to that and contributed our knowledge from existing other like outsourcing projects, and taking also into account bringing in our knowledge from the outsourcing requirements that the regulator has, both for banks and for insurances. And we think this is quite beneficial to have that here. And because I think the digital lending platform industry is not yet subject of the full-blown concept of the regulator. And meanwhile, to counter the argument that this is like unregulated, which it isn't, right? I think it is important to bring forward those standards.
Yes, absolutely. Let's go to the investors field and let's look a little bit closer on this. What you do, why should investors use your platform and invest in residential real estate loans?
Yes, German residential mortgages are actually a very low risk asset class. And that meanwhile gives you a very decent return. I mean, market interest rates have come back like quite nicely. The investment in residential mortgages is a good investment for two reasons. One is investors in a position, we enable them the investment into like a countrywide diversified loan portfolio that is highly granular, because like, you're looking at average ticket sizes of 250,000. And that is secured with a property that has an asset value. That's one. And the second is, if you compare it to the time before the Russian-Ukraine war, market interest rates have increased dramatically and are now anywhere between 3.3% and 4%. This is for a 10-year term loan, and for a 30-year term loan at LTV 80%. And in essence, it is a pretty boring investment with a relatively solid, stable interest and with ongoing repayments.
Okay. And what is specifically so appealing about LOANCOS?
Well, we enable the access for investors, and if you are like a small institutional investor from the pension fund side or from the insurance side, you may not be hooked up with the originators in Germany. The origination platforms are the broker platforms for residential mortgages. And I'm talking about Interhyp, I'm talking about Dr. Klein, I'm talking about Bildhaus. And out of the entire residential mortgage universe, new business, which was last year 285 billion, that is like enormous, 285 billion. And about a third is actually originated through the broker channels. Mm-hmm. So these accesses we're fully linked up with the brokers and are in a position to originate volume from the market quite substantially.
Okay. And which is the largest group of investors? Can you tell us anything about it?
Yeah. I mean, the largest group at this point are institutional investors, which means it's banks, it's insurers, and it's fund managers. Right.
Okay. And do retail investors play any role?
Up to now, retail investors have not participated in that market because they just lacked the appropriate product to be able to invest through. We're actually working on that product, and this is where the journey is headed for. Okay. Because I think the retail market and the retail appetite for a low risk, solidly performing and yield generating credit product is there, and it's just a matter of how you bring it into the market.
And can you tell us about the investment process? How does it work?
Typically, what we originate for institutional investors is a forward flow. Meaning there's no existing portfolio that you basically try to distribute among institutional investors, but it's a forward flow of newly originated residential mortgage loans, and it's fairly straightforward. So what we do with institutional investors, we agree on the underwriting parameters, which basically include everything to do with credit quality, to do with the property, the assets that are going to be financed. Typically, you could regionally diversify. And it's no big secret, but what you do in Germany is you look very strong to, this is like the old Western Germany part, plus Berlin and Leipzig. And these are like the regions where you would originate the mortgages from. And on the basis of these underwriting parameters, we originate the mortgage loans through the broker platforms on a countrywide basis. And institutional investors would typically invest their allocation, they're allocating capital. And so it's a specific amount that they would be looking to allocate to get from the market. And the way we draw down on the capital is also fairly straightforward, because within like a period of 4 weeks rolling, the next 4 to 6 weeks, it is very good conceivable what the drawdown schedule would look like. And on that basis, we'll call the capital.
Okay. Overall, investors really care about performance and also whether they can allocate enough money in the targeted borrower segment. So how do you help investors to achieve these two investment goals?
I mean, the volume question we discussed at 285 billion, I believe that's been the peak of the market, what we saw last year. And also given the market developments, the most recent market developments, the market has come down, right? We don't know the number yet. We'll know it by at the beginning of next year. But the market has always been there. So you could expect it to be like anywhere between 2 to 220 billion, which is large enough to get like an investor commitment filled. That investor commitments are typically, it starts at 2 to 300 million and goes up to, depending on the investor size, obviously, to 800 million or even $1 billion of per annum originated loan volume, which is quite a lot. And so that's one thing. The market is big enough. And the other thing is, if you look at it's very straightforward from a risk point of view. You need to look at the borrower credit quality and you need to look at the property, at the asset. And if these two things, you need to bring this together and to be able to originate loans. And if you have a competitive offering, there shouldn't be an issue in filling these orders. Right now, obviously, we have there's a market disruption, right? Everybody is affected by that. But the expectation, the market expectation is that at some point the market will come back once prices have balanced out, and so the typical sizes, as I said, 2 to 230 billion per annum will be back.
Okay, that brings us to returns. Can you perhaps be a little bit more specific on returns? What can you tell us on this?
Yeah, I already mentioned where the market rates are, right? So that's no big surprise.
Absolutely.
And so the good thing is you always get what the market is offering right now. So if you would have asked the question for like a year ago, market rates were around 1%. Right. So that is difficult. That was difficult for investors to allocate capital. And these days, obviously, market interest rates have risen, but across all the asset classes. So, but for this particular one, I would say, if you look at, we're talking net return now, right? The biggest cost typically is the broker commission. You need to pay the broker, obviously. They're doing a good job here. And this is something that you need to pay 1.5 to 2% upfront. And that's basically the lion's share of the cost, right? And if you compare it to consumer loans, it's even higher than that. That's like the 3 to 4%. And then it depends whether you would annualize these costs over like the next 10 years, right? Or if you basically do it all into the first year and allocate it into the first year and have like a lesser net return. If you look at the net return for German resi mortgages, I'd say from the second year, if you put it all into the first year, then the net return is anywhere between 3 and 3.7% per annum, depending on the term and on the LTV. And I'd say that's a fairly decent net return for that kind of low risk asset class. And on top of that, you get ongoing repayments, so that investors can basically think about whether they would reinvest the repayment or invest into and buy something else. Okay.
You have mentioned that it is all about a low risk asset class.
Yes.
That brings me to my next question. Who performs the credit risk management? Is there any rating? Who performs this?
Right. So this is all about how to keep the default rate low here, right? And it's a mix of several things. One thing is that we stick to the underwriting policy and ensure that only solid credit quality is originated. So that's one side of the equation. And the other side is that all of the borrowers have to accept that we can foreclose immediately. That's a concept here. And plus we have the first ranking mortgage over the property, which actually ensures that we have immediate access to be in a position to foreclose on the asset. That's one big block. And flanking, we have processes that deal with missed payments and have a very, we discussed that claims management at the beginning of our podcast, and have a solid dunning process for that. So whenever a loan is not getting repaid, or there's a loan repayment rate missed installment, and if the dunning process does not result in getting the loan back on track, then obviously we can terminate the loan. And right, and when that happens, then we're in a position to sell the property. And how you sell it in Germany is either through a freehand sale or through a actual foreclosure at the court. And with all of this, we have very relevant practical experience on a countrywide level. And with the sales proceeds, the creditor is in a position to repay the outstanding loan in part or total. And if the sales proceeds are not enough to repay the outstanding loan amount, then we can also foreclose into private assets of the client. And historically, we have very good recovery rates as far as that is concerned.
Can you tell us anything about the rates?
Yes.
And especially as you have already mentioned it, what about default rates and numbers?
Well, as I said at the beginning, German residential mortgages are a pretty boring asset class because usually loan-wise, there's not much action happening. There's only action happening when people move, right? They have a different address or they're getting married and then there's a name change. The most spectacular developments are is divorce or unemployment. Okay. So the whole asset class is fairly boring. We have looked at historical default rates, and over the last 30 years, actually, expected losses have been anywhere between 0.04 and 0.07%, which actually is 4 to 7 basis points per annum. And in portfolios that are managed by us, the actual losses are lower than that. And to give you like a proxy in rating, S&P rating terms, that would be like anywhere like a AA or a single A rating.
Okay. You have already elaborated on how you manage defaults and distressed loans. What I would like to know is how long investors would have to wait until they get their money back. Can you say anything about it? Do we talk about days or
no?
weeks,
In the regular course of business, or what?
In the regular course.
Course of business.
Yes.
Oh, money back. Well, it depends on the structure of the funding, right? Mm-hmm. And as I said, if we were to originate a forward flow portfolio of say 200 million, you would get repayments on a regular basis. So this is not bullet, right? Mm-hmm. So repayments are depending on the repayment rate between 1% and up to 4%, for example. So you would get after 10 years, you'd already have 40% back of your initial exposure.
Mm-hmm. But as you have mentioned it, the regular course, what about the irregular course?
Well,
that's
a good question. And given that we have a very stable legal system in Germany, all of these topics are highly transparent and can be planned. ahead. So depending on the individual court you have to go to, it doesn't take you more than 2 years. I mean, if you have to go through the foreclosure route to get your money back, if it's like outstanding. And if we compare that to like Southern European countries, it could take longer than that. And in Italy, it also depends on the individual court, but this is a process that can take up to 10 years in Italy.
Okay, interesting. One thing we have learned on the Consumer Finance Summit in Cologne that we organized in October together with two institutional investors was that institutional investors are very much interested in how originators deal with a case they fall into insolvency. What can you tell us about this?
I mean, that is pretty spot on. That, I guess.
Well, specifically now in view of LOANCOS.
Oh, yeah, sure. But let me look at this from a backup servicing point of view. And this is what you mentioned, an existing operational platform becoming unable to perform its duties due to insolvency, for example. Is probably the reason why the backup servicing that we offer is one of the fastest growing areas at this point in time. We do this. I mean, we're covering consumer loans, we're covering other financing platforms, and even financing lease structures to do that, because when you have like money outstanding, then obviously all of your borrowers expect you to get the money back for them. And that's a key task. Obviously, the same holds true for us. I mean, right.
Okay, thank you very much. This was very interesting, your view on all these specific questions regarding the investor's perspective. Let's now change our view a little bit and look at the horizon. Let's start with a very important question, which is about the increasing risks, such as the Russian aggression, increasing energy costs, and interest rates that increase, and the increasing inflation. How does all this affect, from your point of view, digital lending as an asset class?
Well, first of all, I mean, that's a crystal ball question, right? And I mean, we looked at this, and then obviously we're shaping our view on the back of past experience, and can come up with like expectations that we have. So when we look at Corona, right? Let's start before that, right? When we look at Corona, the German loan industry has basically shown to be fairly resilient, much to the surprise of everyone. But probably with hindsight, the government aid programs for funding have had their fair share to buffer the effects of the crisis. Well, now the situation is totally different, right? Because we have like a very difficult mix of risk factors, like that are per se already may like show like a real impact in the loan industry. So we have like this is still post-COVID effects that we have. We have disrupted supply chains. We have the war in Europe that's happening, and we have the massive increase in energy prices, coupled with a high inflation, as well as with the very fast increase in market interest rates in the Eurozone. So what we've done within the BKS, Bundesverband Credit Servicing and Ankauf, the German Association for Loan Servicing and Loan Purchasing, that association has been around for 15 years, and we're a founding member. And each year we actually survey the German banks' risk managers, okay? And we call this NPL barometer, right? So this is like one of the key features about the expectations of the risk managers on NPL. And when I look, I've got some figures for you here, right?
Okay, yeah.
So when I look at this, what the expectation is for next year, The expectation for next year in consumer loans is 3.4% NPL ratio. This is up from 2.1% in the first quarter of this year, 2022. Residential mortgage loans, the expectation is 1.9% NPL ratio, and this is up from 0.8% in the first quarter of this year. And then we have commercial real estate loans at 3.1% NPL ratio, and this is up from 2.2% in the first quarter of this year. And then we have the SME loans, which is like the core financing in Germany. That is, the expectation is 3.7% NPL ratio for next year, and that is coming up from 2.7% in the first quarter of this year. And the historical figures I just gave you are from the IBA and or Schufa. So, and that is quite interesting. When we looked at those numbers recently, we saw that the estimates for NPL ratio were actually too high for this year. It obviously, everybody was still under the corona shock impression and was expecting much higher default rates. But that didn't materialize. So the question is also for us, are these NPL ratios going to materialize and show next year? So it always helps. So how is next year going to be for the loan industry? 2 weeks back, the economic expectation and prognosis for 2023 was published by Helab's chief economist, Gertrud Traut, and she got 3 scenarios there, right? The first is you actually walking alongside the peak of the mountain, which basically is like a recession with medium type effects. That's like a 60% probability. The second scenario is like a crash, which is a severe recession, and that is like a 30% probability. And the third scenario is like you do like a family excursion, which basically means there's no big change happening, right? And that's got a 10% probability. So net, the expectation is that there's a 90% probability that we're going to have a recession next year, right? And this is a view that the government also takes. And we're talking on a regular basis with international investors. One of the larger Italian investors actually expects in next year a severe recession at the beginning, and then in the second half of the year, it's difficult to do the timing on that, a shift into a more mild recession. I personally was highly impressed to see what the impact was from the governmental aid packages for Corona, and that they really must have had a dampening effect of the Corona pandemic for the German loan industry. And because the current inflation is in the first place an increase in gas and electricity prices, it could be that the package that was enacted by the government is going to have a similar dampening effect for the loan industry, but we will see. And should there be more subperforming or non-performing loans next year, as a platform, we're ready for it.
Okay. Thank you very much for all the important details. Against this backdrop, please let's once again have a closer look on digital lending as an emerging asset class. This phenomenon popped up after the financial crisis, as we know, primarily. There are some stakeholders that already had operated before, but we leave them away right now. And now we have seen this interest rate anomaly on the markets for more than a decade. Now things, as we have elaborated on, things have changed with a turnaround in interest rates. What does all this mean from a very general perspective for the digital lending market?
That is a very good question. I see digital lending as an alternative, has created like an alternative to the classical bank market. And I think the digital lending market is, you basically can no longer think loan industry without digital lending platforms. Digital lending platforms have contributed to like the overall loan product becoming more accessible to a wider community in the market, and be it because of prior inefficient processes with banks, or be it that there has been no offer before that. And so clearly it's contributed to like an innovation in credit supply. So that's the main reason for digital lending to be obviously has become part of the loan industry. And now there's like, it has evolved into like a coexistence. So actually they're existing side by side, or even you have like banks that are investing in digital lending platforms, or that use digital lending platforms as an additional sourcing channel, or as a channel to basically use it as a channel to like divert client inquiries into those platforms. So I think it's here to stay.
Okay.
Definitely.
Good news. My very last question for today brings me to the current funding problems of fintechs. This is heavily discussed in newspapers, on conferences, between stakeholders, and especially in our association as well. It's a current problem. And what do you think about the future landscape of digital lending in Europe, especially in view of the funding problems that emerged? And where do you see the ecosystem in 1 year from now?
Right. I mean, that's another crystal ball question. And
the last one for today.
I'll try that one. From a funding point of view for digital lending platforms, I mean, I'm not talking here about the equity funding. I mean, that's like an investor case. But if you look at like the way like a forward flow is funded, you always had two options, right? The first is you do it through private capital, which is like private debt, or you do it through public debt. And public debt is like the option to go through like the capital market and issue your securitization program. Now that market is for the time being closed, right? So that's not an option. So the private debt market becomes more important, access to private capital, which means, and then obviously the question is, are you going to get funding next year? The answer is difficult. But if you have like a business model that is convincing and is also resilient, well, that's a bit of that's an ongoing kind of theme, right? That is resilient even in the times of crisis, where you can actually demonstrate that you have the default rates under control and have good recoveries, and can actually deal with slight like performance exceptions in the loans, then you will be in a position to still find investors for the forward flow. And on top of that, if you have like a topic that is like ESG compatible, we haven't brought that up yet, but ESG is very important, the environmental, social, and governance conformity. And if you have that, that is these are like all very good prerequisites to have a successful funding next year.
Okay, thank you very much for this outlook, and thank you very much, Clifford, for your very valuable insights and for your time.
Yeah, thanks very much, Constantin. Much appreciated to be here on the podcast. Always a pleasure.
Thank you, everyone, for listening. I hope you have enjoyed this episode as well. Please make sure you subscribe to our podcast and follow us on LinkedIn so that you will never miss our podcast. Stay safe and sound, and see you soon.